All right, Pralay Mondal, Managing Director and CEO with CSB Bank joins us now. Ms. Mondal, good morning. Thank you for joining us. I'm looking at your numbers. Advances growth 26% year on year, 6% sequentially. Deposit growth 18% year on year, 8% sequentially. While these numbers are impressive, my question is, do you think on a large, now that base has become higher, you can maintain this run rate? A. B. Deposits are lacking advancing credit growth. How are you planning to bridge it?
Good morning, Nikunj, and good morning to all your viewers. Yes, the base has grown. For example, last year our growth was 9%. Now, 3 consecutive quarters, we have grown faster than the system, 16, 24, and now 26. And we hope that we'll be able to sustain a reasonable growth. And as I said before, that we will continue to grow faster than the industry and the banking ecosystem. Yes, our base is low and it continues to be a little low, and that's exactly where we need to continue the growth momentum. On your question on deposit, yes, as you know that there are challenges in terms of liquidity, CASA, and deposit also slower than credit growth. Credit growth has picked up in the ecosystem. But for us, our CD ratio has actually come down compared to last quarter. And overall, I think we are getting the deposit momentum through our branches also. We are adding almost 15-20% branches every year. And our execution story remains intact. So I think we should be able to sustain the growth story.
Tell me a little bit more in detail about gold loans, because as I understand, a large part of your loan growth has actually been led by gold loans. And what we understand is that they've suffered from yields coming down, not being as attractive anymore. Any concern here? And do you see these growth numbers specifically for gold loans being sustainable in the near term too?
Good morning, Aisha. Yes, and this again is a clear strategy for us. What we decided in the beginning of the year that we will sweat the system, and because gold loan investments in terms of infrastructure, people, process is already in. So without additional investments, except for some branches, we are able to sweat the system and grow that. That helps us in our managing our cost to income, because a significant investment, a large part of our investment is getting into technology and building the retail franchise. As you know that retail franchise takes 18 to 24 months to build on the asset side. Doing anything faster can have its own risk, and we are very risk averse. From that perspective, we are very clear that we need something to work for us, which will give the income. And also we are building our fee businesses. If you look at our fee businesses growing quarter on quarter, and once our results comes out, we'll see that we'll continue to carry on that momentum. And hence overall our cost to income actually will remain elevated, but we cannot go beyond a point. So to that extent, gold loan is very important. Secondly, we understand this business. There is, and as you know that globally gold prices has sustained. Actually, it is at a slightly higher end of the curve right now, which also helps. And also the risks are lower, risk weights are lower, and it also gives us yield. Yield has not really come down that much, and it has remained where it was last year for us. So overall, it's a good business to be in. And if you understand that business, why should we not sweat the system? But more important is that in the long run, we don't want to be a gold loan bank only. It will be one of our important products. We will grow our SME, we'll grow our wholesale, and more importantly, the largest growth will come from our retail franchise on our back of technology and other channels which are building.
Could you just put numbers to it and give me some sort of loan growth guidance, if you will?
I have said it, Bas, that we will grow faster than the system. If you take a, quarter to quarter is very difficult to give, but what I can tell you is on a 3-year CAGR, which we have committed to a board as well, on a 3-year CAGR, we will grow almost 40 to 50% faster than the system, which typically would take it to, system growth is around 17-18% expected in the next 3-year CAGR. So we should be able to be where it takes us there. So, and gradually over the next 2 to 3 years, you will start seeing gold loan as a mix tapering off, continues to grow. The gold loan will continue to grow, but other businesses start picking up, whether it is SME, we are doing a lot of work on the SME side. We are doing, starting to segment the wholesale separately, and retail is something where our major investment is going. And as you know, retail is just not a retail asset business. We just launched our credit cards just now, last week. And that's one of the premium products which you're doing. We are tying up with a lot of other players for broking businesses, home loans, kind of. We have our own product. We do it with HDFC Limited also. So we need to have the franchise going where we give more and more products to the customers. And that's the way our CASA and liability, granular liability will also grow. So to that extent, overall, we are well on our path on execution. But, banking business takes time to build the franchise and the platforms. We are very focused, and we have got a great leadership team, whether it's in the technology or the retail, SME, wholesale, operations, HR, everywhere we have put people in place. Credit. We are very, very hopeful that in this decade, you will see a significant growth from this bank into a larger balance sheet size.
Morning. I just wanted to understand from a larger perspective how the year 2023 is going to be different from 2022 for the bank in specific and for the sector at large.
I think the sector is very clear that with the GDP growth expected where RBI has predicted it to be, and India, while we are connected to the global economy, but India seems to be little shining better than the rest, because globally it's looking quite bleak in terms of even what I read today morning. But India seems to be in a better place. So credit growth, as you can see, is coming back, and capex is picking up, etc. While we don't participate in that story yet, we'll participate there after 3, 4, 5 years. But yes, India's story is good. Banking credit growth is coming. The NPA is at the all-time, in a decade low. For our bank, NPA continues to go down every quarter. So I think overall, we are in a good place to be in. Specifically about the bank, I think we should be able to continue. If you look at last year, our growth was muted. We were actually at best at a system growth. This year, we are almost 50% faster than the system, and we want to build a franchise. While the top line numbers doesn't say everything, while our gold loan is showing almost 46, 47% of the overall asset book, but the amount of work which is happening on the other businesses, that will start showing up in the next 2 to 3 years. And that is what is most critical, and we're all excited about it. So the future of the bank is a fairly large mix on the retail side of the business, and SME, and wholesale will continue to have its 25% kind of a mix along this decade.
Okay. Now, I understand also that the Reserve Bank has mandated Fairfax to reduce their holding in CSB Bank by about 10% over the next 2 to 3 years. Is there some sort of a larger plan in place here? Will this largely be via fresh issue of shares, or will Fairfax be selling any shares?
No, I'm not privy to this information. I don't know where you picked it up from, but yes, if we interpret that for the banking ecosystem, the promoter has to bring down to 26% within 15 years. And Fairfax came into CSB around 2019. So that is still a decade away, more than a decade away. Meanwhile, what happens, I think that's a matter of discussion between RBI and Fairfax. I'm not privy to that. Not that I'm aware of anything happening in near future.
Phone probe there. And any challenges that you're expecting on the deposit side going forward?
Deposit side, the system liquidity is low. We hope with the government spending and etc., the system liquidity should start picking up. Having said that, everybody is looking at a credit growth which is much faster than the last year, and hence there will be demand for deposits. Because we are relatively a small balance sheet and we have a good repeat customer franchise, and our renewal of deposits are very high, and we are putting an army of people out there to get new customers to the bank, which will not only help us in liability, also help us in payments, retail, other businesses, SME, etc. So we should be able to manage the growth with the, funding should not be a problem for us as a bank. But yes, overall for the ecosystem, this is a concern which Nikun said in the beginning, that credit growth is far exceeding the deposit growth in the system. And many private banks are somewhere between 80 to 90% of the CD ratio. So this is something which we need to watch carefully.
So, I just want to understand what the loan growth guidance is going forward. And do you think that we can expect you to grow slightly faster than the overall sector? Or is this 20% growth a number going to be sustainable?
First of all, last quarter and this quarter, we have grown by more than 20. We have grown by 24 and 26. We would like to see that we do not disappoint the market. Having said that, our stated objectives internally to our entire management team is we should grow faster than the system by 40 to 50% on a 3-year CAGR basis in the next 3 years. Quarter to quarter, difficult to predict, but on a CAGR basis, we should be able to manage that.
Good to get in your views as always. Thank you so much, Pralay, for taking the time out and joining us today.
Thank you, Aisha. Thank you. Have a good day.